Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings everyone. Welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com. Give you a few minutes to get situated and anticipate this hour. We're going to go over some macro headline risk that entered today. They kind of ran it up a flagpole here and put out a headline that Trump was ready to fire Powell. He's been just bashed for quite a while now, and Vegas odds are rising of him resigning, getting fired, getting demoted. We're going to talk about those odds. And then, of course, this is Hans Albrecht, our options mentor extraordinaire. And this is going to be very focused on all that fun stuff that's coming up off the bottom that basically, I don't want to touch with a 10-foot pole, but he adores, and they're making all kinds of money over there in his channel. So we're basically talking about the macro event risk coming up, and then of course this market melt up into potential meltdown, some of the earnings that are coming out as well, not just this week with Taiwan Semiconductor, United Airlines after the close, Netflix coming up this week, but the whole bevy of earnings expectations and what that's going to do once we go into the next quarter where tariffs will have a bigger bite. So, Hans, we are talking about this kind of backdrop of risk today that did enter in, and it was very interesting because you know how I feel about this Powell rumor of him getting booted. I don't agree it's going to actually work. Nonetheless, though, it did trigger a very big dollar dump and gold spike. Equities recovered from their fall after Trump basically came through and negated the headline saying, no, it's not true. But the damage had already been done for some of the zero DTE folks, I think. Nonetheless, swing traders are fine, trend traders are fine. It was a hiccup. Anything happened in your particular trading today that might have interrupted the apple cart because of this headline risk?
And that's the problem when you get very low volatility environments. Even though the VIX is kind of sitting in there a little bit, as we talked a little bit about last week, we did pull back a little bit on the S&P, but as long as we start hinting at making new highs, I think the VIX sort of takes notice in a way, which is the potential for more of that melt up that you've been talking about in your notes as well. The melt up to the meltdown, but we're in the melt up phase still potentially. And when people are still continuing to sell and press on implied volatility, as I think they have been and will continue to be as we get closer and closer to the August date, I think people sort of see this environment as not really probably doing very much until that sort of fateful day of kicking the can down the road again, probably. But until then, that's the way it's been, either getting the heck out of the way or you are sort of pressing down on volatility to try to harvest those premiums because they represent a little bit of extra yield while you wait. But the problem with that is when volatility is very low, you're short a lot of gamma. So that one single headline has the potential to continue to unravel and cause some damage, and particularly in the world of zero DTE. So those folks who were ready for things to get worse were happy, I'm sure, that Trump came out and assuaged those fears. But that's the reality of being a little bit more aggressive. Some of my fear gauges are really, really starting to tick very low, which makes me a little bit nervous. I do a series called Volatility Ninja. And in there, I talk about how you have to navigate the environment, particularly as an option harvester, because you are on the wrong side of leverage. So you're benefiting from decay and all that stuff and all the things that income traders like, making money while you sleep, making money during Christmas break. And this is sort of the notion that this is sort of money that just trickles in over time. But the risk is movement. The way that I view it is, well, in a very high volatility environment, you got to be careful. In a very, very low volatility environment, not equally, but you have to be very careful as well, because we get into these environments where realized volatility drops into the single digits as it has lately for the S&P, which means things are not really moving very much at all. And every single little flinch comes back again. So really, we have not seen very much movement apart from that little move up towards 62.50 or whatever it was. And so my preferred area is somewhere in between where you're getting a little bit better premiums and it's a little bit more normalized environment. So I think when things get too quiet, I start to get a little bit worried as well, because it doesn't take much. When you're an option seller, you often use something called a delta, which gives you a strike price that tends to get closer and closer and closer to where the market is when option premiums are very low. So instead of selling 1% out of the money, now suddenly you're selling 50 basis points out of the money. It does not take very much news to get hurt. And that's going to be the reality of it. If a big headline does hit and take hold, it could be a very ugly day, really, which is not something we've experienced for quite a while. But for now, it's a little bit more of the broken record. And it's been a profitable broken record for premium sellers and for longs, because it's just sort sort of like, well, there's a bid to the market, CTA, vol targeting, not enough people in the market, not enough people allocated. Maybe there's an AI melt up underway. So there's this underlying bid to the market, and we continue to see that. I was thinking about it before our show, and I thought broken records can be very profitable, because I think as traders, sometimes we get this idea that things have to be two-way, and they don't have to be two-way. You can go months where things just go in one direction, and then as we saw in April, you can go months where it's just all hell's breaking loose. So don't think that things necessarily have to get back and forth that much. They can just be very persistently one directional, and that's where I see some people get into trouble. They go, well, we've come so far, I'm going to start shorting this market. I'm going to start buying a whole bunch of puts. Someone reached out to me just a week ago and they said, I'm kind of getting killed. I bought tons and tons of August puts, and the market just keeps going up and up and up and up. And they're fighting a trend that is very much entrenched. And so until, you always like to say, we need that trigger, and until we get there, it's just going to be the broken record and more of the same.
Well, let's go over what happened today just with this Powell headline, because I think it is part and parcel for the risk that definitely enters in.
I'm a little surprised we came back from a TLT at 84.5.
Let's just show this chart. This is what happened live. Of course, I closed my trading room and we had the headline, sources say from the White House that Trump is going to fire Powell. And immediately you can see, this is on a 2-hour, I have this heat map that I show clients during a live trading room. We dumped and gold spiked. Now the Qs didn't move very much. They really didn't. SPY did soften. So the market obviously reacted to that VIX print, which did spike higher. And I'll show that in a second. Crude, it doesn't really matter in regards to the Powell headline, but yields do. And yields got a little bit hot, but they did not pierce above that 4.5 lever. And that's important. We're not there yet. This is what VIX did. This big old shake and bake. And ironically, it hit 1950 and they sold aggressively. That's a really popular, by the way, level. So this is up there forever on my charts. It's a really strong resistance level historically, 1950. And sure enough, it went up and then it went right back down. And that was the intraday VIX. And lucky or good, I had actually posted, this is a head fake. This, I don't trust it. I don't believe this. And sure enough, Trump came out pretty soon after. It was all kabuki theater. I said, don't fall for it. Literally, I don't believe the rumors. Gold spiked. This is true. And dollar dumped. But that was really the one big tell that we got out of this whole drama in this magic moment, because it will tell us what happens in the future when Trump comes in to disavow himself of the Fed policy not cutting, which is very much the case. It's very likely that Jackson Hole in August, Powell will be very flat lined, if not hawkish. And September, odds are also falling for a rate cut. So it's more likely that when we do get closer to that May 2026 event, which is Powell leaving by his own schedule, that is literally when his term expires, right before that, that's when Trump can kind of try to play this card of demoting him. I personally feel very strongly that Powell's not going to leave and Powell can't get fired, but Powell could be quote unquote demoted, but there is no precedence for that. There is one case, and I got pushback on this, but there is one case where back in 1948, Truman did demote quote unquote the sitting chair, but it was 4 bloody days before his term expired. So that's not really a case. A case is where it can be contested, and there was no ability to contest because he had to step down anyway, naturally, 4 days later. Anyway, long story short, that is definitely what spiked the intraday volatility, and it was volatility. And the only thing that stuck from all of that drama that I just highlighted for you, this bear steepener. So it has been 100 days also. It has been 100 days since this trend line in the E-minis has been broken. This is from Sunday, the 6th into the Monday intraday low, that's SPX 4878, before Trump came in on Wednesday, April 9th and said, okay, we hear you credit markets and bond markets and equity markets. We're going to delay the tariffs 90 days for rest of world. Remember that? And then the rest, as they say, is history. And if you fast forward, we had one tag right here, which was literally, I was on vacation, and it was Sunday, Monday into the Iran-Israel industrial de-escalation. So markets were trying to get going to the downside, and then the bunker bombing and theater, and then the market got supported and gapped up on Tuesday. And ever since then, we have stayed above 100 days from that Sunday ES tag to yesterday. And we just broke below it yesterday. Something else happened, which I thought was kind of interesting. I had been talking about Nvidia going to that 172. It's not really rocket science. It's just a technical trend line. It does not mean the market's just going to roll over because of that. It just means that's typically where we would get some digestion. And then this morning, I loved Jay from Volland's comments, so I incorporated them in my market thoughts to clients, which is right here, similar to what you just said as well. Capped upside. Jason said 6280 is a major inflection point for the August OPEX. Above it, we have a strong move to 6,400. Below it, and there's modest support down to 6,200, and breaking below 6,150 can create quite strong downside. And if I show you E-mini chart again, what do I have right here? Remember that key level that I had as a price target back in April? I said if we get above, boom, we did. April 23rd, we're going to head up into that 61.27 E-mini price target. We did. And then once we got above it, obviously it's very bullish. But if we do start to stay underneath this trend line and start to break some of these lower levels, we're going to head back to that 61.27 ES, which is very similar to his 6150, which is strong support until it isn't. There's an air pocket of risk underneath that.
Yeah, and I wouldn't rule that at all at this point. We're even seeing a few select semiconductors start, not Nvidia. It's kind of interesting. A lot of them kind of led Nvidia, and then Nvidia eventually got going again. Now Nvidia a little bit sticky up there at 170, and a number of other ones are starting to keel over just a little bit. So it's natural that there's going to be maybe a little bit of a little breather at this point as we go into what is typically a quieter period. And then, of course, as we mentioned last week, we start to look towards September, which is not a great month. So sort of the August, September, October sort of rise in the VIX as people get a little bit nervous.
We have actually a few things before then too. We've got the QRA, which is the quarterly refunding announcement at the end of July, right before the FOMC on the 30th. This is how Treasury Secretary Bessent figures out not just the amount, but the composition of how these bills, shorter duration to longer duration, treasuries are going to be offered up so as to fund our rising fiscal deficit. That's key. More important than the FOMC meeting itself. August 1st with the tariff rollout. That's key. Non-farm payrolls. That's key. Are we going to see an increase in jobless claims? Are they going to start to materialize, etc.? So we do have a lot at that time frame. And then, of course, the 12th, which I happen to think is more interesting, is in fact the China tariff deadline. I think there's a lot more impact to markets on what happens with the China tariffs.
Yeah, I think Powell's is on labor watch. We've seen a little bit of stickiness to inflation, but I really don't think it's a big issue over the long run. But labor is going to be the issue. And so it'll be interesting to see at that point how quickly this sort of unraveling of the labor market starts to happen. It will happen. And I might be watching too many Jeffrey Hinton videos lately, but there's definitely a risk we're starting to see softness in the sort of entry level areas, which it's interesting because it sort of calls into question the whole traditional mechanism of how people move through firms and companies and get groomed and move up through the various levels, moving up the ladder, as they say, the higher echelons of their professions. If AI displaces many of the entry-level jobs, you don't have that supply of younger, eager laborers to sort of move up through the system. So it'll be very interesting to see how that plays out over time. AI is going to really throw some things into disarray. So I think that's going to be a big issue. You mentioned last week, the potential for societal unrest and things like that. So
I'm not in the societal unrest. I can't look that far in my crystal ball. I'm really good with short duration. So not to bet against America. We have some innovations. We also have some very influential people with self-preservation first and foremost in mind. Trump among them are actually leading them. I think there's a lot of runway before any of that happens. So I don't live in fear. I think fear is a prison. So I can't project that. I don't even worry about that. I can't see it. What I absolutely can see is a continued monetary regime that is switching very strongly into fiscal dominance, which means lower dollar, which makes objects like assets appear larger. I can see an age of grift. That's why all kinds of stuff is running hot when it shouldn't. But it doesn't matter because we've got lots of money and speculation, and that's the rah-rah. And it is very important right now for our market backdrop to kind of outrun this, in other words, growth, outrun runs the debt and the servicing of the debt. These are the spirits, the animal spirits that continue, because honestly, if we had natural price discovery, we wouldn't be buying the stuff that we're trading. There'd be a much better focus on value things over paper. So right now, the monetary shift that's underway is really manifest in gold and definitely commodities. This is something that I think is very, very strong. Not oil. Oil, I think, is actually still falling as it relates to, that's my thesis since last year. And I think economic surprises aren't going to be front and center until we actually see more of this lending breakdown like Jeffrey is discovering. So he did a serious due diligence on Wells Fargo yesterday. So they're like, nope, we're not going there. We're going to let the originators, the SoFis of the world, take on this risk. They're actually backing away from lending. Very much top of cycle behavior, very much 2006 before the 2008 behavior. Yeah. So that type of stuff takes a while to work in. This de-dollarization takes a while to work in. Higher yields will take a while to work in. Inflation, same. I know you're excited about the AI benefits, but it also has that dark side of higher joblessness. So higher joblessness working its way into recession, it takes time for these big levers of housing and lending and such to turn. And then once they do, we have crisis. But it does not materialize early and give lots and lots of warning signs, except for those who are really focused on it. So Jeffrey's one of them, for example, when it comes to bank lending, etc. So we're going to trade whatever is right in front of us. And it's been fabulous. The drones and the the Bitcoin and the Ethereum, this stuff that is moving higher because it's an off ramp instead of inflation into things is actually very, very tradable. So is gold, but it's not something that's sustainable, unfortunately, for a really strong economic backdrop, in my humble opinion.
I try to keep an eye, like you, to sort of have the different time frames, and I try to keep an eye to what could happen somewhere down the line. Right now, I'm focusing on the picks and shovels, the companies that are, the way I sort of look at that whole sector is, well, we don't really know. If you look at sort of some of the software companies, you'd think that they would be real beneficiaries to what is happening under the hood on the physical side of things. The software companies are supposed to, I mean, I think the Palantirs and Snows do okay, but you look at the charts of CRM and Adobe and some of these companies that can get disrupted by AI fairly significantly. I think you kind of have to have an eye on everything. And I don't believe in the area of technology that all boats will be floated by the tide. I think there are some mines in the minefield there. I do think that overall, maybe potential for the overall market eventually broadly benefit from the efficiencies, the productivity gains, things like that, maybe margin expansions. We talked about Goldman and things like that. I think there's some companies that are going to really, really take advantage of that. But somewhere down the line, that's going to be the question. But as you said,
only if consumer health holds up. And right now there are signs, early signs, that they're actually borrowing to maintain their status of consumption. So these are the early signs of macro concern that can start to increase and then becomes mainstream. And once it becomes mainstream, then it's too late. The market's already collapsed.
You mentioned SoFi. People sort of put SoFi and Hood together. They're very different things, right? One's very much more a bank. And the thing is, the smart management is to hopefully see what's coming. And I see SoFi moving away from personal loans. I think that's a really, really good move. So when you're looking at financial companies, you want to really figure out who's going to be holding the bag. If the labor market starts to really get hit, there will be certain segments that you don't want a whole lot of exposure to.
SoFi would be a solid short.
Yeah. So, I mean, they are making some moves. I have been looking a little deeply into it, and they seem to be making the right moves to sort of diversify away, reduce the market share that they have of personal loans. But again, I agree with you. That's one where you have to be a little bit careful there. It probably appeals to the younger generations, which are having a little bit of trouble. So I think it's very much going to become, if what I think plays out and what many people think could happen, I think it's going to be very much the rich and non-rich gap just getting larger and larger and larger. So I think that's how you have to look at things. And then within the AI space, I believe it's going to be, for me, what makes me most comfortable is the companies that are going to sell like the picks and shovels. I don't know who's going to figure this out in the end. We don't really exactly know, but we know that the people selling them the equipment are probably going to do okay, because this is a feverish, increasingly feverish thing that everyone's going to have to allocate larger budgets to this stuff. So the Nvidias and things like that, I think those places remain interesting because it's not that nice to have, it's becoming the need to have.
Which companies?
Nvidia, Broadcom. I think without Broadcom, you don't have data centers. Some of those equipment makers, I think some of the interesting things like Nebius and CoreWeave, but concept of being able to sort of have this rent a GPU is going to be a very big thing. And then I think you can risk a little bit towards the things like Palantir and Snow. I think we're going to create generate data on a level we just can't even conceive of. Saw the other day that we're going to generate more data in the next few years than we have in the history of mankind. And that really makes sense because this inference stage is really where the rubber hits the road and we start to crunch data like there's no tomorrow. I mean, it's just going to be, that's the inference. It's starting to use more levels of compute to achieve some sort of utility from AI. It's no longer just, hey, Nvidia is making a lot of money because they're selling a lot of GPUs. It's, okay, how does that now play out throughout the economy? So I read a cool quote the other day and they said, well, the internet, because some people have said this is bigger than the internet. And you're like, well, that sounds incredible. And I think it could be, because with the internet, you have to log in, you use your phone, your browser. With AI, you are constantly logged in. You are part of the system that is going to be our world over the next, it's all around you. It's constantly scraping data. It's constantly trying to infer some value from that. God help us, whatever that's going to mean in the long run. And it's going to be like a hoarder's dream of data and where are we going to put it and who's going to crunch those numbers. And I think there's the opportunity for a company like Snow, and maybe there'll be other ones as well, or Palantir, to make sense of it. Of course, they're wildly expensive, but I think that total addressable market is so big that if you get a sell-off in those stocks, I think that could be very interesting places to chip away at a good story. Remember, markets are about narrative. In the long run, they're supposed to be about fundamentals, but a very strong narrative can trump fundamentals any day of the year.
And in answer to the question, Sean, about liquidity flows that topped on Thursday, I saw selling underneath the surface Friday. We made a lower high on Monday. We had selling on Tuesday, and we're back to making a lower high today. On a week-to-week basis, we're completely flat. So we've done a lot of grinding last week. We've done a lot of grinding this week under the surface with sellers net, in other words, net buying over selling, because everything is an auction of buyers and sellers. We're still basically going sideways, long story short, but we are intraday making lower highs. So there is some risk of short-term shake and bake. We do have a July OPEX, and that is going to set free potential bears into August. But remember, it can also have this headline risk type of backdrop where VIX spikes and then they sell it aggressively. Keep that 1950 in mind for VIX, because it needs to get and stay above there to be durable. So yes, I still see this very, very summer kind of chop playing out for a few weeks. I have not gotten my 1550 yet.
You haven't gotten your 1550. Well, the melt up means you won't get your 1550. Maybe if we recycle back to 610, 6100 or so, 6150, then you might get it, because then we're sort of in the thick of a range. And we opened at a new high yesterday, I think it was, and then pulled back a little bit. And as long as these animal spirits are sort of alive, here's your ARC, which is Kathy Wood. Wood is a four-letter word here, but she's making a comeback. And so we see those animal spirits are very, very alive and well. So of course we know the Nvidias and the Microsofts of the world, the steady balance sheet heroes that are going to continue to do well. But this is your picture of Froth. Okay, so if we look at this is the one that I've been talking about for quite a long time. Yes, you did this
last week and you said it's actually still bullish, and it is actually still bullish.
It is. It's still bullish, but we pulled back here. I said we're going to pull back a little bit. I didn't know how far, what moving average. This is the middle of the Bollinger Band. And here we are pushing again, and we made a new high today. So we hit this 0.29, which is a meaningless number. It's just the ratio. If we start to look further back, we can see that we're getting into a range on this ratio. For folks who haven't watched this in the last couple of weeks, this is ARC versus the big cap. This is froth money. This is excited money versus the regular excitement of innovation. So here we are breaking through to levels that we haven't seen since just about ChatGPT-ish, right around here. So if we continue up, it brings into view this here. I hate to say it. I'm not saying this is reasonable. I'm not saying stocks should be trading up here. This is where Square was 400 PE. This is silly. This is Looney Tunes market. But let's face it, if there's some runway to what I'm saying, and I think there is, then maybe we get up into here, and this is going to be a fantastic trading market. You can own some of these things and you can ride them up, and it's going to be amazing. We saw Rigetti, things like that. And some things are just starting to go a little bit with that excitement. And so this is up here is where throw fundamentals out the window. Don't call me and say, oh, but everything's overvalued. Don't call me. When we're up in here, it doesn't matter. Like you said in your one note, this is not my first rodeo. I understand stupid markets, and I'm willing to play stupid markets. So this is going to be a lot of fun, but it's also going to be a market where people go, how on earth did a stock go from 50 to 100 to $200 in like 3 weeks? This is going to be the kind of market we could get into if people just want to do this. And we can see the silly money is starting to move in. I don't know if you see it that way, Samantha. It's sort of the reality of a difficult under the hood kind of reality versus AI. They're headbutting each other. That's the narrative. Is AI going to save us from ourselves and underlying deteriorating?
I think it's just a narrative of a bullish backdrop for speculation, full stop. And as long as liquidity is still abundant, which it is, we got the OBBB passed. This is the fiscal spending. The animal spirits are happy. Deregulation, SLR relief for the banks. I mean, the list goes on and on and on. So they can speculate in the micro crap, micro cap. I will show you what I mean by that. So
crap, I like that.
It is, but this is very, very, very usual. This is the factor rotation where hedge funds make a mint shorting Peloton from 80 to $80 to $8 or what have you. It doesn't matter. And then they start feeding this frenzy of open's going to be worth not $2.50, but $86. And everyone's like, oh, I got to get me some of that. So what happens is it forces these prior shorts to cover because they're getting their head handed to them and they don't want to sacrifice those magnificent profits all the way down. So what's happening is this, which is basically micro small cap relative to the micro crap. Micro crap is outperforming really, really, really well. But this is also telltale signs of market froth. And like you said, it can trigger a lot of short covering in a lot of stuff that can move higher, some justifiably, others not so much. Here's an example. Also, I was just asked in QA, you were asking about trend line in the 400 week and that kind of stuff. Okay, but here's a weekly trend line. So you're referencing mention that I had about the weekly trend line. So here's UUUU. This is rare earth related. This is an example. There are tons of them. And you can see where this has done beautifully. It's powered higher. This was recommended last week because of MP. MP, of course, was Department of Defense came in and it rallied 36% on a 40% position. So it wasn't a contract. It was a position. They're nationalizing MP, which is partly Chamath and partly China. Long story short, UUU is just an example of the weekly trend line, boom, moving higher. Now, there are a lot of other examples. AMD is another, when you're talking about the 400, forgive all the messiness, but this is another example. When I was writing about this, I said, here's the 400 week. Yes, the 400 week EMA. And tons of stocks in this most recent bloodletting in the Trump tariffs into the policy intervention of April 9th, they looked like this. They came down to the 400 week, including small caps, by the way, IWM, including, oh goodness, there are so many names, CSX, IWM, Marvell, going back to AMD. AMD was a perfect setup. Perfect, because it had not only the 400 week, remember, this is why I always pull back in time. I always look at the grandparent, then the parent, then the child, because this did a great job of tagging that trend line, doing a gorgeous scoop pattern and moving higher, because AMD is not going out of business. It's very different than a QS, for example, which happens to be a prior SPAC that basically got the short covering treatment, or open, which is also a trend line tag. So there are tons of these. I mean, I go over so many every single morning with clients, and some of them they're actively chasing and or positioning. But the pumper in it open says it's worth $86. Some people are going to follow that particular Pied Piper to their end. But the point is, it's very, very popular. So no wonder ARK and others are popping up from the grave. It makes perfect sense to me. But the problem is, it's also perfectly timed with blow-off tops. So we're not even at a blow-off top. We're not even there yet. But it is kind of 1998, 1999-esque.
So was the question, where are we? Are we 98? Are we 97 and a half? Are we 99? We're not 2001 yet, but we're right in the midst of shitcoin for stocks. So it's just everything under the sun is starting to go and everybody's got a reason for it and everybody's smart again, which is always the fun part of this kind of market. You just feel like you can't go wrong. So it's fun, but you just want to make sure you're not caught holding the proverbial bag in the end when they come down. But I think we could get, another 6, 8, 10 months of this sort of thing. And in the stronger story, stronger narratives, I think we just get kind of waves of little sell-offs and rallies. And then you've got Bitcoin as well, which is, of course, starting to pick up again. I think we talked about it last time, my Vega bailout strategy, which was buying IBIT, a higher delta IBIT call, and sort of looking at this implied volatility and saying, boy, this is pretty low here.
And this is the Bitcoin breakout where I'm just showing that chart right here. And Ethereum is the new Bitcoin if you follow Tom Lee. But also Ethereum is controlled 42% of all outstanding Ethereum is owned by BlackRock. So again, this is a great technical trading environment. This is gorgeous. Both of them are, of course, are moving up, which is also a telltale sign of this froth. So until they peter out, until Netflix really wants to come back in, the mean is down here at 150 and it's printing 171. So all of this market is very, very tradable. We're not into a short or a rollover situation yet. But I think the hedges, like we talked about every time, we got the Nvidia 172 price target, but that does not mean I'm expecting this market to crap out here. I still need to see macro trigger interrupt the bullish flows. We had a little headline tease today. I didn't believe it. I didn't trust it. I know Powell is not doing what Trump wants him to, but Trump also does not have the legs to follow through. He does not have the precedence. He does not have the power, believe it or not. Shocking, I know.
He's the taco man. He showed his cards, and I think he just truly wants to get rich, and he doesn't mind everybody else getting rich. So I truly believe that that is his new kind of standard. He doesn't want to be called taco man. Yeah. I mean, look, that's what it is. And I think everyone is starting to realize that. But beautiful move on Ethereum here. Even gave us just a little pause for a couple days here as we stood atop this trend line here and then continuing to break out there. Somebody asked me about it a few days ago. I said, I really like it, but I did not position in it. But I position in it yet. I do want to take a look at that implied volatility. We can see Bitcoin, Ethereum's leading Bitcoin right now. I mean, Ethereum had a tough time for a little while there as stablecoins competition fired up a little bit. And I think it is now starting to be recognized as that important smart contract coin that may be adopted in a serious way. And I think Tom Lee doesn't hurt. It's starting to get a little bit more of that credibility from folks like that. And so what I did though on IBIT is I put on this Vega bailout strategy, which was just basically long a bunch down around 61. And I said, listen, I think this is either going to continue to break out, which was sort of right around here when we started to break out above this little channel. And I said, look, this is my favorite setup. You get super, super low implied volatility, right? This is where you can use long options favorably. As everybody else on the Twitter sphere and YouTube is saying, oh my gosh, the juice is so fantastic. I'm selling options. I'm selling covered calls. No. You're not getting anything. You're not getting enough when option pricing is sitting at super, like look at pricing on MSTR. That does not get me excited about selling covered calls against my stock. And if I look out a little bit further to 70, let's say we go not quite a year out. Let's see what we get here. Look at that option pricing, this cheap. So that's where I will sometimes go in and say, listen, this thing has got to make a move. At some point, it's got to make a move. It doesn't, but it's got to make a move at some point. So I go, okay, so I'm going to position in basically what is a strangle, which is basically buying out of the money calls, buying out of the money puts. But you can do it in a more directional fashion by making those calls a little bit closer to where the market's trading. So the calls you buy are a little bit more expensive. They have more delta, more upside exposure. And then you pick up some cheap El Cheapo puts way out here somewhere that can potentially bail you out if this thing goes catastrophically wrong, which is sometimes what you get with a big breakout of everyone believes, and then something happens and the sell-off is catastrophic because so many people got in and the narrative completely changed. So that's where that kind of strategy can really make sense, because you know that you're either going to benefit from your long delta and very, very cheap option pricing, right? So one of the risks as instruments move up, stocks move up, is that they compress option pricing. Well, when it's already super, super, super low, it actually has the ability to rise. So when you look at some of those longer term options, you can say, well, look, I think they're very cheap here. And if we do what Bitcoin can potentially do, let's face it, it can, we don't know, but you could get going 150,000, 200, I don't know, anything can happen. And so that's where implied volatility is actually going to rise. If this thing has an explosive move, you are going to see option pricing start to reflect that. So you can benefit from that as well. That's the kind of trade where you can really do well to the upside. The only thing that doesn't work for you is if suddenly we just sit around again. But if it does that, you can always change your mind, and the option pricing is so low that it's probably not going to get hit too hard over the next 3-4 weeks or a month, 3 or 4 weeks, if it does indeed sit around. So that's the Vega bailout. You're delta long, you're going to do really, really well. But if it collapses, you're going to have these out of the money puts kick in and the implied volatility is going to rise. So on a big drop, you may not even lose anything. You can see here you're losing a little money, but I'd have to vol shock it. So if I raise this up 6-7 volatility points, you're actually not going to lose any money to the downside. So that's a unique little setup that you can look for when option pricing is very low, when you feel like you're about to get a nice move. move, but you want a little bit of a protective soldier sitting down here just in case you get it completely wrong.
Which have you done that tactic on?
Oh, all kinds of things. I have it on the IBIT right now, and the timing was good. I had one on MSTR a little while ago. I think I lost small on it because it didn't move quickly enough. I have new MSTR positions on now that are doing great. But that's the thing. You can be completely wrong on direction and maybe not lose any money. If I can be really long into an idea and get it completely wrong and not lose money, that's a nice setup for me. So
Like that.
yeah.
And Mauricio makes a great point. He's like, I'd be very hesitant in selling the market ahead of Nvidia earnings on 8/27, which also times really well. VIX is bottomed in July. This is seasonality. It's also my 1550. But the point is, we still have this very firm ability to go sideways until we get a disappointment from Nvidia or a macro headline. And even then, Trump pulls it back. So he ran that up the flagpole today to see how the market would react. Well, gold spiked higher and dollar dumped viciously, that he was told really what the market will do on an announcement if Powell was to leave early. And I think that's another little game that he plays. But the same thing would happen with, I think, any major earnings disappointment. He's really going to try and, don't worry, we're doing great. We got it all figured out. But we also have a crystal ball that's a little foggy. But as we get into September, there is, believe it or not, shutdown risk that's in the, I don't know, what do you call it? Like out of the corner of one's eye. Alex is actually staying on that and then feeds me some intel, which is very, very helpful. But honestly, this is another way for Trump to gain more power regarding the spending. If they don't allocate the spending by a certain time, then he could literally use these little nascent hidden rules and laws and come in and do some surprise there. So we actually have some more risk coming into September, but it's not talked about now at all. And believe it or not, it has to do with shutdown risk, even though he already got his OBBB passed. So that's something else for September to be mindful about.
It's big and it's beautiful, that bill. So if you believe it, it's true. If you say it enough, it's going to be true. So I don't know. I think Nvidia has had a good run. I thought Goldman, I mean, as much as I love it, I thought it's had a good run. You know, it's going to pull back. And I actually did buy some puts. I have a whole bunch of long-term calls on Goldman. And I thought I'm just going to hedge myself a little bit. So I probably threw $5 or $6 down the drain. But that's okay because I figured, you know, if it pulls back, I'm going to monetize that. So going into earnings, you could do a couple things. If you really think you're ambivalent about where it might go, you can collar it out. You can sort of sell some calls up somewhere and you can use that to finance some downside. And then if it starts to go up, you can unwind those calls to the upside. Or if you really believe in upside, don't cap yourself. I see people do that all the time and they kick themselves 6 ways to Sunday. So is that the expression? 6 ways or 7 ways to Sunday? I don't know. Anyway.
We suck at idioms.
I know.
But the question, we're getting a few questions in regards to hedging. So I know we've talked about this. Hedges only cost money. But until I can see that selling underneath the surface that is persistent, breadth starting to roll over, right now, sucker's been strong off of that intervention low. And we got 100 days until that trend line that I showed you broke. So we still have a little wobble. There's no question. But that doesn't mean it's shortable yet. I'm going to defer to you on this, but you also were talking about a Nomura piece that said we're getting closer to hedging. What's your thought on that? Because right now the market is in its summer storm season. The volatility, like you said, it doesn't have to go any lower and market can still move higher. So we don't really have that as a tell. I've got no pattern or selling or breadth destruction yet. little signs intraday, and maybe it'll work from the inside out, but it's not enough to get excited about. We've got Nvidia 172, but they've got earnings in a month, and who wants to mess with that? So tell me your thesis on hedging a portfolio. I know some people do hedge every single position. Client Tim, literally, he hedges every single position, but I'm asking for portfolio management, risk management. What's your take?
And that's where you can have a bit of a more of a blanket approach by beta weighting your portfolio. So you can kind of get all your positions into a platform that can beta weight, and then you take your whole mishmash of what's going on out there. And this is not a perfect science, but you can figure out, you can sort of benchmark it against whatever you think your sort of broadest theme is. It might just be S&P, it might be QQQ, Q, and then you just say, well, look, this portfolio looks like a 0.9 beta to the S&P, and that's going to give you an indication of how much protection you need in the S&P. And so you're going to go out, and so for example, here is, I don't think protection is very expensive, even though we've seen skew kind of get pushed down a little bit. We're seeing that upside calls. What's happening is, we did talk about this either last week or the week before, people are starting to buying that upside. So instead of maybe buying the market, they're buying upside to not have to commit fully to it, but just in case. It's pushing up that upside skew, so that call skew. So if anything, callers are kind of pricing not too badly right now, because you can sell those sort of more expensive calls and use that to finance some of the downside protection that you might want to own. But if you look at something like this, I think this is quite reasonable, especially if you're up money. The problem is, I think a lot of people kind of go, well, you know, puts, it's like tossing money in the garbage. And a lot of the time it is, but it serves that purpose, kind of like your house insurance. You don't want to make that call and say, hey, listen, I got to exercise my puts on my house because my house burned down. So you don't really want to have to make that call, but it gives you that peace of mind that if something happens, one of your largest assets is indeed protected. And you should probably look at the market the same way. And a great way to really, in the S&P, for example, you have such steep downside skew. What that means is the way out of the money puts tend to be quite expensive versus the at the money, and certainly versus the calls. The call side is usually a terrible trade to sell, which is why buying them, we always talk about how the upside is cheap. I've always found over my decades of having done this, one of the greatest trades in the market is upside index calls, just long index calls, because they're usually underpriced. You don't just always buy them, but when the momentum's underway, that's when you get those climbing the wall of worry type markets, and that upside is too cheap. Like, look at the last couple months. I mean, the upside was cheap. We talked about it for about the last 700 points. If you look at this downside put spread, you can buy a December 590.25 put spread for 810. That is not bad. Look at that. You're spending 810, and you could turn this thing into, on a 10 lot, you're going to spend $8,100 and turn it into 57 grand. I mean, that's at expiry. So if the market goes down, you are going to be following this magenta line. The blue line is expiry, and that's certainly, the expiry line is valid. There will be advisors out there who are not in this to trade it. They're in this to protect the way that this position is meant to protect, which is, if the market closes in December under $500, I'm going to get the full value of this put spread, just like the JPM caller. They own a downside put spread. They're not trading it. They're not saying, oh, maybe I'm going to get out here because I'm calling a bottom. They're going to wait and see what happens. If you're more of the trader variety, you're going to be looking at this magenta line and say, okay, I may not get the full value of this, but at 500, I'm going to get, you know, maybe like 2/3 of the value, maybe a little bit more. And also, you're going to do a little better because the volatility is going to explode. So notice that you're long a lot of Vega, which is going to get counteracted a little bit by this short Vega short put down there. So that may counteract a bit of that effect, but you're going to make money. So this is where you can use some of this leverage. And if you look at the cost of this, let's say you own the SPY and you're up $250 on it for 5 months protection, going into a very uncertain AI world and Trump world and all this stuff going on. $8 is not a lot to spend.
You did a great job talking about it, but show us the chart.
Then here's your put spread. You're spending $8. Look at this beautiful, beautiful P&L here. You're spending this to potentially make this. I think that's pretty good. You're going to protect yourself between $590 and $525. So you're going to get a full $65 of protection. And as I said, by selling, I mean, you don't have to sell that downside put, but you're going to get a little bit of value for it from that skew that I mentioned. Those downside puts are expensive. So, and for the most part, people are not betting on the end of the world. They're betting on, okay, it's going to be a healthy correction. We're going to go down 10, we're going to go 12%, 15%, whatever it is. And as I said, advisors like these kinds of structures because they are not looking for the end of the world, but they would love to be able to protect a portfolio to the tune of that amount. And that's putting leverage on your side, right? When you're selling if you were to sell this spread as an option income trader, you get the opposite of it. You're risking a whole bunch to just make a little bit. But from the protective perspective, this prices nicely, even though skews maybe not, I'd have to look at December. In the short term, skew has been flattened a little bit, but that's not bad. Out to December. This fall, anything can happen.
It's really funny because I'm looking just today when you're very still excited about this oversold rally in whether it be the micro caps or the ARCs. I mean, obviously they invest in actual companies, but the point is today, out of my list of 103 ETFs, okay, I always look at this every single morning, what's leading, and I'm tracking this. The top 5 ETFs that led today, ARKK, ARKW, ARKX, ARKF, ARKK. Q.
I bought when this broke out right here. I did a video on it. I have the evidence, bought a whole whack of calls, and I have not sold them. That's the thing. Like, it's one thing that I think retail, and I had somebody reach out the other day and they said, I can't get ahead. I make money, I lose money. I'm just paralyzed. I don't know what to do. One of the things you need to learn is sometimes you got to give up a gain in order to really push a gain. And so it's the same old cut your losers short, which I don't even do that well sometimes, but let your
you
winners
use
run
defined
sometimes.
risk and options. It's very different.
It is. Yeah, you have a limited risk if you're buying some calls. Absolutely. It's it. And that's the nice thing about them. But I'm letting this run. Now I'm taking a look at it going, boy, maybe I should start taking some profits a little bit because it's had a good run. But then I look at that longer term chart of maybe this becomes another mania.
But that's the same thing we're doing with the market. It has done nothing wrong yet. And so anticipating market risk is absolutely my job. I want to look at everything possible that could be a market risk. And by the way, firing Powell is not on my bingo card because I don't think it's possible. Demoting him closer to the event, maybe, but we got months, we got miles to go. Anyway, the point is there are a ton of other macro event risks, but the market hasn't done anything wrong yet. Your ARK hasn't done anything wrong yet. Your Goldman hasn't done anything wrong yet. We have a system right now that is still supporting speculation full stop until it does stop. So it's kind of hard to get in front of the train, if you will. I know that's a popular expression, but right now gold is a very, very successful train for those who are more macro risk aware. And I think that's really where I wanted to, for lack of a better word, kind of end on that subject, which is to say we've got a situation where...
What's our trigger, Samantha? Is there a yield trigger? I mean, TLT at 84.5 starts to make me go...
Yeah, no, this is, as far as I'm concerned, this over and over and over and over and over and over and over again, we're not there yet. So for example, in December, and I'm still on this, actually September, but especially December, September 18th, literally the morning of, before the Fed came out with a 50 basis point hike, I have a client post that says, time for a yield spike. We've gone 100 basis points higher, more, in the 30-year and 10. The point is, Trump and Bessent are not going to be successful in getting yields to fall in this fiscal dominance regime, full stop, without a recession. And even then, prices can rise and yields can stay very sticky. So that's it. We're going to keep going up as far as I'm concerned with yields. And the dollar will keep falling because that's a feature, not a bug, of their policies as it relates to tariffs, de-dollarization, which helps these, by the way, these speculators pile in to whatever moves. So you definitely have objects appear larger. I keep saying that. But this bear steepening in the 10-year and 2-year that I've also talked about since December, saying I have a target. Don't buy bonds until it is at plus 90 basis points. We've hit my plus 45. We've hit my plus 65. Now we need to go and hit that 90. And then we will have reason to buy bonds or TLT for those who home gamers. So I think we're just going to go nowhere fast until we reach that level. And that means we also have to watch the 10-year, but I don't think it's a serious headwind until it gets and stays above 4.8%. The problem is the rate of change. When these things happen with dollar or yields, it's not the direction and the slowness of where it's moving. That's all very controllable. That's the Goldilocks zones for equities. It's the rate of change that will determine the severity of the impact. And for right now, other than the intraday rate of change in that dollar, for example, spike yesterday and then dump today, we haven't really had much. We have a bounce, but a controlled one. So it's not a headwind. We have to have solid freak out, panic occur. And then what happened last time, April 9th, he came in to calm down the bond market. And today he did that little game with Trump headline about Powell, and yields didn't move very much, but that bear steepener triggered because bonds have a longer memory. Equities, not so much, but bonds have a much longer memory. So that's it. I think we're still going to be in this regime of the market has done nothing wrong yet, including your ARK. We're waiting for a reason for that it has. So in the meantime, okay, we'll pick this up next Wednesday. We're getting into the meat of earnings. We'll talk about earnings plays in particular. But this week, it's really Netflix, which has been hot fire flames as a result of also trade tariff money that went into Netflix as more of a domestic safety play back in April, if anyone looks at a chart. Now we'll see if it can really live up to those expectations now that the market has kind of absorbed all the tariff rates. The decision about the tariff rates before the threat of the tariff rates flowed right into Spotify and Netflix, thinking they were trade war resistant. is what I'm trying to get at. So now the price has appreciated so much. Let's see what Netflix actually comes for real numbers.
I'll never go down again, Samantha. Let's just admit it. But you are not going to give up your Netflix. Don't even tease us. You love it. They're getting, sports, more sports.
They're going to sell Netflix and buy Open $2 because they think that's going to be the next Netflix or something like this. Anyway, good luck, everybody. We'll talk to you next week. Cheers.
See you, folks.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.